Hello everyone and welcome to Financial Accounting with Anne-Marie Anderson. Today we will be learning about closing entries. Before we get into it, let's take a look at where we are in the accounting cycle. Closing entries are prepared as the very last step. You may have heard of people in business talking about closing the books for the year. Well, that's exactly what we're doing. I always think of Scrooge McDuck working on his year-end close when teaching this topic. Okay, on to the actual definition. Closing entries are end-of-period journal entries used to transfer the balances of temporary accounts into retained earnings to reset the temporary account to zero for the next accounting period. How do we even know which accounts are temporary and need to close? Let's go back a couple of steps in the accounting cycle to the income statement and statement of retained earnings. The time period reflected on these statements is for the year ended December 31st. That means that these statements show cumulative data for the whole year that has passed. These are called temporary accounts and include all revenues, expenses, and dividends. So basically, every account on these statements. In order to start the next year with fresh numbers on January 1st, these temporary accounts must be reset to zero. Let's get started on the closing entries to make that happen. Step 1 is to close revenues to income summary. This is the general ledger, and every account used during the year will have its own ledger. We start with the revenue ledger, which shows our earnings for the year. Remember that a T account comes from the ledger because it looks like a T. Rather than use the ledgers, we're going to switch over to the T account format because it's easier to visualize the closing entries. If revenue has a credit balance, then the only way we can set that account to zero is to debit it for the same amount, making the account balance zero. For closing entries, we have a new account, Income Summary, which is only used to assist with the closing process. We have our debit to revenue, resetting the balance to zero, and our credit goes to Income Summary. The next step is to close our expenses to Income Summary. Every expense is going to have its own ledger account, so we'll just pick one to illustrate, wage expense. We have to close all expense accounts the same way. Since wage expense carries a debit balance, as all expenses do, we credit the expense to close it and reset the balance to zero. That credit to wage expense is then offset by a debit to income summary. You see here that they don't balance, but it's because wage expense is just one account, when really every expense account needs to be closed as well. For simplicity, I included a credit to various expenses. At this point, let's review income summary. We moved all the revenues and expenses to income summary, so the balance is actually net income, revenues minus expenses. Step 3, close income summary to retained earnings. Now we take the total of income summary and transfer that balance to retained earnings with a debit to income summary and a credit to retained earnings. Basically, we are taking net income, the money we made this year, and adding it to our retained earnings balance. Well, income summary has done its job for the year and the balance is zero. This account does not show up on any financial statements and is only used as a tool to prepare closing entries. Step 4, the last step, we close dividends to retained earnings. Dividends is a temporary account found on the statement of retained earnings, but we follow the same process. We credit dividends to set it to zero and we debit retained earnings directly. Looking more closely at retained earnings, we start with the 1/1 beginning balance of the account. We add the earnings from the current year and then subtract dividends paid to stockholders, which leaves us with a new 12/31 retained earnings balance. That T account is the exact same format of the statement of retained earnings, with all the same information, but in financial statement form. Our new year-end retained earnings balance is used in the stockholders' equity section of the balance sheet. The balance sheet will not balance without that updated retained earnings number. We have two types of accounts, temporary and permanent. Temporary are the accounts we close, which include revenues, expenses, and dividends, as we've just covered. Permanent accounts are the ones that don't close and carry forward to the next period. These are your balance sheet accounts, assets, liabilities, and stockholders' equity. Let's take a minute and summarize why we prepare closing entries. We prepare them to measure income accurately for the period, to update retained earnings for the period's activity, and to prepare our temporary accounts to begin the next accounting period. Our 4 steps: close revenues to income summary, close expenses to income summary, close income summary to retained earnings, and close dividends to retained earnings. That wraps up closing entries. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.